What you see on screen right now is a world map from the website visualcapitalist.com. It shows that in the year 2000, most of the countries in the world had the United States as their largest trading partner. Fast forward to 2024, the picture changes drastically. By the end of 2024, most countries now had China as their largest trading partner. Cards on the table, I believe that China's economy faces major issues, the biggest one being the demographic structure of its population. However, on the issue of trade, most analysts miss the fact that China knew that this day would come and spent many years and a lot of money preparing for it. The United States continues to be China's biggest customer in terms of exports, but when we hear this, we might make the mistake of overestimating how big a customer the U.S. really is. Back in the early 2000s, the United States represented over 20% of China's total exports, while in 2024, the number had gone down to just 14%, meaning that its reliance on the U.S. market has decreased. A trade war will hurt China for sure, but it won't cripple it. And since the U.S. has gone to war against the whole world, not just China, a rearrangement of global trade around the Asian giant could end up benefiting China's political and economic interests. In order to assess the potential impact of tariffs, let's look at some statistics. On the day of the publication of this video, President Trump paused tariffs on the rest of the world for 90 days. As a member of the European Union, France was facing a 20% tax on all imports. When we look at trade and other economic data, we then realize that the United States represents a mere 7% of all French exports and barely 1.5% of France's GDP. Another interesting case is Japan. The land of the rising sun sells 5 times more to China than it does to the United States. Even by looking at the United States' backyard, we see that an easy win is unlikely for either China or the U.S. However, most South American countries now trade more with Beijing than they do with Washington. These include Brazil, Uruguay, Chile, Bolivia, and even Argentina, which is now a close ally to the Trump administration. This can be replicated to many other regions. China has solidified its position as a major trading partner for over 150 countries and regions, with its circle of friends in foreign trade continually expanding. In 2024, China became the primary trading partner for the European Union, surpassing the United States, but the EU continues to export more to America. If the United States continues with its hostile stance towards the EU on trade, that too is likely to change. Trade between China and the EU reached $709 billion, compared to $671 billion for trade between Brussels and Washington. The Association of Southeast Asian Nations has also experienced a notable shift in its export patterns. In 2023, China's exports to ASEAN member countries surged to nearly $600 billion monthly, positioning the bloc ahead of both the US and the EU as China's largest export market. The increasing number of countries exporting more to China than to the U.S. has several implications. The shift reflects changes in global supply chains, with China serving as both a manufacturing hub and a significant consumer market. As trade balances shift, geopolitical alliances and economic policies may evolve, influencing international relations and economic strategies. Make no mistake, the Trump administration's indiscriminate imposition of tariffs on various countries may significantly alter global trade dynamics, particularly affecting nations in Latin America and Asia. Over the past decade, China has made inroads in that regard. For instance, in Peru, Chinese state-owned company COSCO developed the Chancay Deepwater Port, enhancing trade routes between South America and Asia. This initiative is part of China's Belt and Road Initiative, aiming to bolster its global trade influence. We made a video explaining how these investments weren't without controversy, with reports of slave labor in some cases. As far as trade with the region is concerned, China's trade with Latin America surged from $12 billion in 2000 to $315 billion in 2020, with projections estimating it will exceed $700 billion within a decade. This growth reflects China's expanding role as a key trading partner in the region, often surpassing the United States in trade volume. In Asia, U.S. tariffs have led to significant shifts in manufacturing and trade patterns. Companies seeking to avoid tariffs have relocated production from China to Southeast Asian nations such as Vietnam, Thailand, and Malaysia. This migration has bolstered these countries' economies and deepened their trade relationships with China. However, the imposition of tariffs on Southeast Asian exports by the U.S. has posed challenges. For example, Vietnam, which benefited from manufacturing shifts, now faces tariffs ranging from 24% to 49% on its exports to the U.S. Though these tariffs have been temporarily paused in order to allow for negotiations, these developments may prompt Southeast Asian nations to further diversify their trade partnerships, often turning to China for economic collaboration. Mexico and Canada are two of the United States' closest and most significant trading partners. Thanks to the North American Free Trade Agreement, NAFTA, and its successor, the United States-Mexico-Canada Agreement, USMCA, trade between the three nations has flourished for decades. In 2023, U.S. exports to Canada were worth over $350 billion, while exports to Mexico exceeded $320 billion. Together, they account for roughly one-third of all U.S. exports. Tariffs imposed on Mexico and Canada during the Trump administration, particularly in 2018 and 2019, targeted key materials like steel and aluminum. While these tariffs aimed to revive U.S. metal production, they created significant stress in Canada and Mexico's manufacturing sectors, especially in industries closely tied to cross-border supply chains such as automotive, construction, and electronics. When production costs rise due to tariffs, companies in Mexico and Canada either absorb the higher costs, reducing profits and economic growth, or pass the costs on to consumers and businesses, leading to inflation and lower demand. As these economies face headwinds, they may scale back imports, including from the U.S., in response to weaker domestic demand or retaliatory tariffs. A weakened Mexican or Canadian economy, whether due to tariffs or broader trade uncertainty, means less purchasing power for U.S. goods. This is particularly problematic because the U.S. trades heavily in intermediate goods, components and machinery that go into final products assembled in Mexico or Canada, and then often re-exported to other countries, including back to the U.S. Slower growth in Canada and Mexico could reduce demand for U.S. manufacturing and agricultural exports, delay or cancel cross-border investments, or undermine long-term confidence in North American supply chain integration. Trade policies that damage the economies of close partners risk boomeranging back to hurt American exporters. Rather than reducing the trade deficit, they can shrink the overall volume of trade and push long-standing partners toward alternative markets, such as China or the European Union. In an increasingly interconnected world, policies that treat trade as a zero-sum game often end up being counterproductive. The Trump-era tariffs, while politically popular among some U.S. industries, may ultimately erode the very domestic strength they sought to build. China has been diversifying its economy away from the United States. Anyone who thinks China was caught by surprise by this tariff war has not been paying attention. This is Latinometry. Subscribe to the channel so that you don't miss any other interesting videos about Latin America and the world. Please like and share this video, and thanks for watching.